Our next guest believes policymakers will find a resolution on the fiscal cliff before the package of tax increases and government spending cuts kick in. That's just one of the predictions in Morgan Stanley Smith Barney's 2013 market outlook that came out today. With us now, the firm's chief investment officer, Jeff Applegate. So, Jeff, why do you think that Congress is going to be able to come through with a deal on this fiscal cliff?
The political calculus, Susie, is very simple. At the end of the day, the fiscal cliff threatens to tip the U.S. economy back into recession. That's bad for all incumbent politicians, whether you're in the White House, Congress, regardless of party. So we think that's what will drive a deal.
Now, you know, the fiscal cliff is in headlines every single day. It's probably going to continue like this for the next 6 weeks. How is all that anxiety going to play out in the markets?
Well, you've already seen it playing out since the election. U.S. equities, global equities, actually were down more than 2%. We didn't have a great day again today. So getting a positive resolution on the fiscal cliff is going to be important for the markets, but it's going to be volatile and it's not going to be sorted out soon. So I think you should count on near-term, possibly increased volatility in equity markets.
But you still think that the markets will be up for the year for 2012?
We do, and that's a view that the fiscal cliff will get resolved in a positive way, and the threat of recession will be removed, and the market should respond positively to that. And then the outlook for 2013 is that the economy is growing, profits are growing, and you also have the potential for longer-term deficit reduction and equities doing even better than going up in line with profit growth, potentially getting price earnings multiple expansion.
All right, well, that's really encouraging, and yet investors are really concerned about what they should be doing to positioning their portfolios. Now, in your market outlook that for 2013 that was released today, you're advising this allocation, generally speaking. Everybody's different, of course. Global stocks, 38% of your portfolio, global bonds, 38%, alternative investments, 21%, and cash, only 3%. Give us your analysis on this allocation.
Well, let's start out with the last part first, cash. If you stay in cash, then you're basically getting return which is below inflation. So you're not even protecting your purchasing power and thereby, I think, really breaking one of the cardinal rules of investment. So it really makes sense to move out to somewhat more risky asset classes, which could be investment grade credit, could of course be equities, but also commodities where you have the potential for a positive post-inflation return and also a positive after-tax return.
Jeff, I'm sure you get this question asked a lot. If you've had some decent gains in your stock portfolio this year, 2012, given that they were expecting increases in capital gains and dividend taxes, should you take your profits between now and the end of the year? What do you tell your clients?
Yeah, I tell clients actually everyone's tax situation is different. And I also tell them don't let the tax policy decision overwhelm your investment decision. If in fact you have an investment goal which is multi-year, long-term, which a lot of our clients do because they're households, they're not institutions, then in fact you shouldn't make any change in terms of your long-term investment strategy around the fiscal cliff, which is going to be a short-term event, which again we think is going to turn out with a positive outcome.
All right, it's a very confusing time for investors. Just overall, what's your best advice for people right now?
I think the best advice for people is whatever investment policy you thought was appropriate in your portfolio at the beginning of the year, that's what you should adhere to coming into the end of the year, despite the threat of the fiscal cliff. We will get through this, and then again, the next opportunity for investors will be next year, where keep in mind the credit rating agencies are waiting in the wings potentially to downgrade U.S. debt. We think that's going to help get politicians focused on a credible multi-year deficit reduction plan. And if we can get that, as I mentioned earlier, then you have the potential for equities to do even better because then potentially you get price earnings multiple expansion.
Very reassuring and encouraging. Thank you so much. Jeff Applegate, Chief Investment Officer at Morgan Stanley Smith Barney.